Unfortunately, the sad reality is that most investors lose money in a stock market crash. However, if you have the right mindset and the right investing style, instead of losing money, you can actually make a lot of money. So you might think I'm a bit crazy by saying this, but let me show you that Peter Lynch actually thinks the same way. For those who don't know Peter Lynch, he's achieved an annual average return of 29.2%. That's higher than Warren Buffett's. And this is an old interview that I'm going to show you on what he says about stock market crashes.
Are you concerned about the volatility in the financial markets today? Do you think something needs to be done to reduce it?
I love volatility. I remember when in 1972 the market went from down dramatically, and Taco Bell went from 14 to 1. They had no debt. They never had a restaurant close, and I started buying at 7, but I kept on to it, and it went to 1. And it was the largest position in Magellan in 1978 when it was bought out by $42 by Pepsi-Cola. And I think it would have gone to 400 if they didn't buy it out. I think volatility is terrific. I think these callers are very important. I don't think the market going up 80 points one day and down 80 the next is a good thing for the public. I think that's not a very good thing. But I think all of these callers and all these other things, to keep the volatility down each day is important. But the market's going to go up and down. Human nature hasn't changed a lot in 25,000 years. And some event will come out of left field, and the market will go down or the market will go up. So volatility will occur, and markets will continue to have these ups and downs. I think that's a great opportunity if people can understand what they own. If they don't understand what they own, they can own mutual funds, try and figure out mutual funds they own, and keep adding to it. Basically, corporate profits have grown about 8% a year, historically. So corporate profits double about every 9 years. The stock market ought to double about every 9 years. So I think the next market's about 3,800 today, 3,700. I'm pretty convinced the next 3,800 points will be up. It won't be down. The next 500 points, the next 600 points, I don't know which way they're going. So the market ought to double in the next 8 or 9 years. It ought to double again in the 8 or 9 years after that. Because profits will go up 8% a year, and stocks will follow. That's all there is to it. But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own.
And right now, as you all know, we are in the midst of a stock market crash. Stocks are down well over 20%, and we're in the height of panic. But the question is, what do we do? So there are 3 key takeaways I'd like to point out from this clip. The first is that over the long term, stocks are going to go up, because you have to remember that a stock is a part of a business, and businesses, at the end of the day, their main goal is to make money. Now, do you think in 3, 5, or 10 years' time, businesses will be making more or less money? Of course, they'll be making more. As Peter Lynch said, corporate profits grow around 8% every year. This means, due to compounding, they double around every 9 years. The stock market, therefore, ought to double around every 9 years. Okay, so you need to know the first principle in order to understand the second principle. The second principle is that you want to be buying stocks when they are low, when the crash is at its height, because over the long term, things are going to go up. So when would you want to buy? When is the best time? Well, at the bottom, of course. A market crash is good for us investors. As Peter Lynch says, I love volatility. This brings me on to the third principle that I need to point out from the video, and that is to buy good quality businesses. I mean, let's think about the examples that he used in the video. Taco Bell. Back then, it had no debt and no restaurant closures, and it was a fantastic business. Lynch knew over the long term it would go up. I mean, he mentioned Coca-Cola as well. Over the long term, it was inevitable that it would go up because it was such a good quality business. But this brings me on to arguably one of the most important principles to follow when it comes to investing. I want to let Peter Lynch explain it though.
I made 10 or 15 times my money in Dunkin' Donuts. Those are the kind of stocks I can understand. If you don't understand it, it doesn't work. This is the single biggest principle. And it bothers me that people are very careful with their money. The public, when they buy a refrigerator, they get a Consumer Reports, they buy a microwave oven, they do that. They ask people what's the best kind of radar range, or what kind of car to buy. They do research on apartments. When they go on a trip to Wyoming, they get the Mobile Travel Guide, or California. When they go to Europe, they get the Michelin Travel Guide. People will hear a tip on a bus on some stock, and they'll put half their life savings in it before sunset, and they wonder why they lose money in the stock market. And when they lose money, they blame it on the institutions and program trading. That is garbage. They didn't do any research. They bought a piece of junk. They didn't look at the balance sheet, and that's what you get for it. And that's what we were being driven to, and it's self-fulfilling. The public does terrible investing, and they say they don't have a chance. It's because that's the way they're acting. I'm trying to convince people there is a method. There are reasons for stocks that go up. Coca-Cola, this is very magic. It's a very magic number. Easy to remember. Coca-Cola is earning 30 times per share what they did 32 years ago. The stock has gone up 30-fold. Bethlehem Steel is earning less than they did 30 years ago. The stock is half its price of 30 years ago. Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated. People get too carried away. And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict interest rates. I mean, if anybody would predict interest rates right 3 times in a row, they'd be a billionaire. Considering there's not that many billionaires on the planet, it's very, I had logic, so I had a syllogism and studied these when I was at Boston College. There can't be that many people who can predict interest rates because there'd be lots of billionaires.
No one is going to be able to predict what happens in the stock markets over the short term. It's just not possible. They might get it right once or twice if they're lucky, but they can't do it regularly or they'd be filthy rich. But we do know that over the long term, the stock market will go up. And that's why it's so important that when stocks are down and cheap, aka right now, we do start investing for the long term. But as Lynch says, these must be in companies that we understand. We must put the time and effort into learning the balance sheet, the income statement, looking at the profit, comparing it to price, all of the basics. If you don't go through them, odds are you're going to come out on the bottom. The other thing that Peter Lynch recommended was that you need to know history. So if we go back 75 years or so, it does give us a good picture of how the market works. One takeaway that we should get from this graph is it's pretty much what I've been saying throughout the whole video. The points, the heights, the midst of crashes is generally the best time to invest in the stock market when the prices are cheap. Not necessarily when things are all well and rosy, because then things are more expensive. It's honestly quite basic. It's funny. This reminds me of a quote from Warren Buffett. He said this when he was asked on what his best investment advice is. He said, when an individual with cash meets an experienced individual, that individual with experience ends up with the cash, and that individual with cash leaves with experience. And this just shows you how important it is to have knowledge, experience, and expertise, because there are basically two ways to gain these things. One, by living to 60, 70 years old, investing and learning along the way. Or two, is by learning through the experience of others, the likes of Peter Lynch, Warren Buffett, etc. And that's what I'm trying to do in this video, getting you to learn things through the experience of others. And what were the key things that they were saying? 1, crashes are a good thing for smart investors. 2, you need to be buying stocks during market crashes. 3, don't just buy anything, don't just buy any stocks, buy the good quality companies. And lastly, make sure that you understand the company before buying. These are so key.